Why not just take the guaranteed 5 on high-yield savings or T-bills over the stock market? Recently I had someone review my portfolio free work benefit to have a financial advisor with Bright Plan. I have about 50 in stock 401k IRA, but lately my other 50 has been going to a high-yield savings account which currently gets me 5.5 with the bonus. He was saying for my age that's too risk-averse, and that even 5.5 is under the annual return from the stock market. But from my POV, I get a guaranteed 5.5 that compounds monthly. Why wouldn't I take that over the stock market at the moment? Because of days like today. Equities are where you make real money, but you got to stay invested. The guaranteed fixed income is great for older people nearing retirement or people planning to make a big purchase, home, etc. But you gotta remember the market averages 7 over the long term. It's not a guaranteed 7 every year. So by locking in that 5.5 you could be missing out on so much more. Perfect example is this year. VTI is up 16 YTD. Also all the market gains this year have come on like 10-15 days. So yes, you've gotten risk-free 5.5 but missed 10 growth not adjusted for inflation. One big drawback is the short-term taxable gains during your prime income years. My marginal tax rate is like 45 here in Cali. So that 5.5 is basically cut in half. Whereas I can hold SPY and get 8 without any need to sell and realize a gain until I'm in a lower income bracket in the future. But from my POV, I get a guaranteed 5.5 that compounds monthly. Why wouldn't I take that over the stock market at the moment? You are not getting 5.5 return per month that would equal out to roughly a 90 annual return. You're getting 5.5 annually. With the math on what's paid out per month working backwards to give you your current monthly return, including compounding. I think with the risk-free rate at 5.5, an argument can be made for keeping more cash on hand and waiting for the market to drop. Yes, this is technically market timing, but 5.5 risk-free isn't too bad to sit on. Long story short, 1. 5.5 is great, but not guaranteed. People forecast it go down next year. 2. Suppose it goes down to say 3. It's not easy to switch to another investment because stocks or other assets would have gone up, making it more expensive. 3. Finally, 5 yearly is nice, but if homes go up 7 every year, you're never going to able to afford anything. Anyway, reported CPI is 4. So you're only making 1 real 10 vs 5. Over the course of decades it adds up. Also cash is a trap. If you don't want to invest in stocks now, if in a year when cash rates are hypothetically 3 and the stock market is up 15, will you switch then? Or will you stick with cash because the stock market is way overpriced now? A year later when cash is down to 2, if the stock market has roared another 15, will you be ready to jump in at all-time high prices? Do you see the market today? I already made more in 1 hour in my portfolio, which is less than what's in my HYSA than I would all month with my HYSA. It swings both ways. I get a guaranteed 5.5 that compounds monthly. Why wouldn't I take that over the stock market at the moment? Because the stock market returns more than that. Interest rates could be lowered in the future, which would both lower your HSA yield and likely boost stock prices. Or the opposite could happen. No one really knows the future. Your guaranteed 5.5 is only guaranteed if you have a locked-in term. HYSA tend to move with Fed rates on a monthly basis. The 5.5 return you are talking about is before inflation, which is currently around 3, so you're only getting 2.5 after inflation. The stock market over the long term traditionally returns around 10 or around 7-8 after inflation. You don't say how old you are or how close you are to retirement. You should have a sensible asset allocation for your age and time to retirement. I would argue that 50 in fixed income is too high unless you are already retired or very close to retirement. Great short-term plan if you are going to buy something in the near future. When rates go down, you should be prepared to buy something more long-term. The past 3 years have been psychologically hard for anyone that accidentally peaks at their retirement. I'm 100 VU and similar ETFs. In my taxable, I treat it more as my flexible spending account, so I do tend to do more market timing without much success, especially compared to my buy and hold accounts. Maybe someday I'll learn. Because until very recently high-yield savings accounts weren't even worth looking at. That 5.5 is not guaranteed forever and will eventually decrease at some point in time. So there needs to be a plan for what happens when rates decline. To have a substantial allocation in current assets is perfectly fine in the short run, however, it's not a great permanent allocation. I get a guaranteed 5.5 that compounds monthly. Why wouldn't I take that over the stock market at the moment? Because, on average, the stock market will get you close to 8-10. The downside is the stock market will bounce up and down a bit. So it's not always great in the short term. But it'll average around 10 over the long haul. So would you rather make 5.5 or 10? Because long-term market returns are higher. And because against inflation you're making almost nothing. Bonds HYSA have a time and place. And it's not 50 of a young person. Because the market already prices in the opportunity cost of the high return on risk-free assets. In other words, the expected returns on stocks increases as interest rates go up. If risk-free treasuries paid 10, then stocks would decrease in value to provide expected returns higher than 10 to compensate for the additional risk. This is exactly what we saw after the historic inflation of the 70s. As interest rates came back down, the stock market delivered unbelievable returns all the way until the year 2000. 1. I'm up 20 YTD in my 401k and the SP 500 has an annualized return of 10. 2. That 5.5 won't last until your retire. And even if it did, you would be leaving a lot of money on the table in comparison to the near double rate of return of the SP 500. Look at market today, up 2-3 in 1x200B where ya at T-bills. Because I almost got 5 just today on the stock market. Because of days like today. Take Bank of America stock for example. It's probably too big to fail. So, it might go lower. But if you feel like you've bought pretty low, it has room to go up, and unlikely to lose all your money. It yields about 3.4. So if it doesn't go up, you have that. But get this, it's up over 5. Today. In one day. Yes. It could be down that much tomorrow. But locking in 5 per year, for the most part, is not going to match the higher growth potential of equities. Especially over the long haul. When you consider growth companies. Technology. Fixed 5 just isn't enough in comparison. Markets today alone are up 2 on SPY 500 and 4 on Dow. If you stayed HYSA for the entire year, you'd probably average 5.1. Year-to-date SPY 500 is up 18. Because days like today. Because small cap were 6 up just today SCHA. Here is the most likely scenario. You're leaving it there because that's a guaranteed 512 over an uncertain market. What's really gonna happen is when the market starts going up, you're gonna think it's a head fake. And by the time you pull your money out and put it in the market, it's already gone up 10 or 20. Maybe even more. That's what we call getting whiplashed.